Okay, let's just dive right in. While, most of the world was focused on holidays, leftovers, all of that, the digital asset world was running its own high-stakes stress test.
It really was. Yeah. Traditional markets were closed, but crypto never sleeps.
Exactly. And some critical structural changes happened that are going to matter a lot heading into Q1 of 2026. So our mission today is to give you that shortcut. We're going to tell you everything you need to know about what happened over the, 48-hour Christmas and Boxing Day window. We're not just looking at charts here.
No, this is about the structural shifts underneath.
We've pulled out two huge themes that really define where the market is headed. First, there was a very distinct liquidity stress test on Bitcoin's price. And second, we saw this fascinating governance bifurcation in DeFi.
That's the perfect way to frame it. These were not random holiday price swings. These events, they really highlight a dichotomy,
A dichotomy between
between the fundamental resilience of Bitcoin's network and, at the same time, the fragility of certain market segments. It's all setting the stage for the first quarter of 2026.
All right, let's start with market mechanics then. The Bitcoin price action was, it was bizarre. We had incredibly low volume, which should mean wild volatility.
Right, holiday chime.
But instead, the price was just mechanically pinned, stuck in this impossibly tight band between, $85,000 and $90,000?
Yeah.
So where it gets really interesting is why? Why was it so stable?
Well, that stability was, you could say, almost entirely manufactured. It all boils down to derivative positioning.
Okay.
We had approximately $27 billion, that's billion with a B in crypto options contracts, that were all set to expire on December 26th, Boxing Day.
And that massive expiration created what's called gamma pinning. Can you maybe give us a quick analogy for that? It's a key concept here.
Absolutely. Think of the price like a metal ball that's stuck right in the middle of two really powerful magnets. Those magnets are the options contracts. The market makers, the dealers, they sold those contracts. So to remain delta neutral, which just means they want to avoid taking on too much directional risk, they had to hedge.
So if the price moved...
Exactly. If the price tried to dip towards 85,000, their models forced them to become buyers. If it tried to run up towards 90,000, they were forced to be sellers.
So they're creating this gravity, just pulling the price back to the middle.
That's a perfect way to put it. It's like mechanical gravity, and it completely masked any of the underlying weakness that was actually in the market.
And there definitely was underlying weakness. We saw 5 straight days of net outflows from the U.S. spot Bitcoin ETFs. The total was over $825 million.
Correct. The spot market was clearly seeing some heavy selling pressure into the year-end. And the biggest signal, for me at least, was the behavior of BlackRock's IBIT.
The big one.
Yeah, the fund that has just been a relentless accumulator. It recorded a really rare, significant outflow of $91.4 million.
So what does that tell you?
It tells you that traditional finance allocators are busy. They're doing year-end tax loss harvesting, rebalancing their portfolios. They were locking in gains or, just getting set for 2026.
So you have this huge tension, mechanical stability from the options, butting up against this real spot weakness from tax selling. So now the options have expired, that pin is gone. What happens now?
Well, now you get the classic coiled spring dynamic.
Right.
The second that $27 billion pen is removed, all that artificial suppression just vanishes.
Yeah.
I fully expect we're going to see an immediate expansion in volatility.
Something's got to give.
Something has to give. We're looking for a decisive test of those boundaries, either resistance up around 92,000 or that crucial support at 85.
And before we move on, what about the network's health? Did all this price stress affect the miners at all?
Not in a fundamental way, no. The network's health is still remarkably robust. The difficulty adjustment, which is, a measure of how hard it is to mine, it happened on Christmas Day. And it saw a tiny increase, just plus 0.04%. To see any increase while the price is on the defensive, that's actually a bullish divergence.
So the big industrial miners aren't spooked?
Not at all. It suggests they're sticking with their long-term plans. They see this price weakness as just, short-term noise.
Okay, so let's move away from Bitcoin's plumbing and into DeFi governance. Our sources are pointing to what we're calling a governance bifurcation. Basically, DAOs are growing up.
They're demanding real value, not just participation trophies.
Exactly. And our first case study is the Uniswap unification vote, which passed overwhelmingly. It crushed the quorum requirement.
This was a landmark vote for DeFi, a really huge deal. It did two massive things. First, it authorized the burn of 100 million UNI tokens from the Treasury.
That's a huge deflationary event right there.
Immediate and tangible. And second, and this is the crucial part, it finally activated the protocol fee switch for Uniswap v2 and v3.
And now all those fees that are collected will be used to automatically buy back and burn even more UNI.
Precisely. For years, people called UNI a valueless governance token. This vote just completely flips that narrative. It's a decisive shift towards direct value accrual for the people who hold the token.
It sets a precedent.
A huge one.
Now let's contrast that with what happened at AVE. Their token alignment proposal was resoundingly rejected. 63% voted against it.
The contrast is it's stark. On paper, the proposal sounds fine, right? Move assets like the brand name from the dev company to the DAO.
Sounds good for decentralization.
It does. But the key factor was very loud, very public opposition from huge institutional stakeholders, like Wintermute. Their CEO, Evgeny Gavoy, basically argued that the proposal just didn't have a clear economic plan for token holders.
So it was just a procedural change without a clear payout.
That's exactly the question it raises. It confirms that DAOs are moving past governance theater. They will not rubber stamp some ambiguous power transfer unless there's a clear, tangible economic benefit.
Like Uniswap's burn and fee switch.
Right. They're demanding functional value capture, not just procedural control. It's a sign of maturity.
Okay, we have to talk about the most significant negative development, which highlights a vulnerability that really everyone should be thinking about. The Trust Wallet browser extension compromise.
Yes. This was a sophisticated supply chain attack. It's so important to stress. This was not a flaw in a blockchain or a smart contract.
The attackers went after the app's distribution.
They did. They found a way into the update mechanism and injected malicious code into a specific file in version 2.68 of the browser extension.
So if your extension just updated automatically, you were exposed the next time you unlocked your wallet.
That's it. The script was designed to just harvest your private keys and seed phrase the moment you unlocked or imported a wallet. The estimated losses are around $7 million.
And it's crucial to point out, mobile users were safe. The risk was totally isolated to the browser environment. Why is a browser extension so much more hostile than a mobile app?
That's the core of the whole issue. Browser extensions just operate in a uniquely dangerous environment. They interact with all this complex software, other extensions, the browser itself.
The attack surface is huge.
Exponentially larger than a standalone, sandboxed mobile app, which is why the mobile users were completely fine.
So what's the strategic takeaway from this for anyone managing serious capital?
It just reinforces what we call the client-side risk thesis. For any significant amount of money, you should never, ever rely on these hot browser-based wallets.
Use hardware.
Use hardware security modules or air-gapped cold storage, period. And I should also add the response from Binance founder CZ saying Trust Wallet would cover eligible losses. That sets a really high and welcome standard for user protection.
Let's pivot now to regulation. The holidays did not slow down governments from finalizing their frameworks for 2026.
No, we're seeing a really significant move toward clarity, especially in Asia. Hong Kong's FSTB and SFC. They published their conclusions for a new licensing regime for virtual asset dealing and custody.
So they're expanding their scope beyond just the big exchanges.
They're building out a full-stack regulatory framework. The new rules will cover OTC dealers, brokers, standalone custodians. The focus is on extremely high standards for key governance and segregated client assets.
Institutional grade.
Absolutely. So legislation is aimed for 2026. Hong Kong is building a very clear, safe on-ramp for traditional finance.
And speaking of regulatory complexity, there was a report from AMLBot that highlighted a major difference in enforcement between Tether and Circle.
Yeah, the numbers are pretty staggering. Between 2023 and 2025, Tether froze about $3.3 billion across more than 7,000 addresses.
And Circle?
Circle froze about $109 million across just 372 addresses. It's a 30-to-1 disparity in frozen assets.
So what's the difference in their models? Tether is proactive and Circle is reactive.
Right, it comes down to speed and independence. Tether works preemptively with law enforcement. They'll often freeze funds based on intelligence before a final court order is even issued.
And that freeze, burn, and reissue thing.
That means they freeze the tainted tokens, they destroy them, and then they reissue clean tokens to the victims once it's all confirmed. Circle, on the other hand, is much stricter. They will only freeze funds when they get a formal court order.
So that philosophical split, proactive versus judicial, That's going to be a big debate going forward.
Oh, absolutely. It's setting up a policy battle over fungibility and centralized control. This is going to be a central theme for regulators, especially now that Tether is planning to launch its US-8 stablecoin for the U.S. market.
Okay, finally, let's wrap up with a look at corporate strategy. The infrastructure is definitely solidifying for 2026.
It is. We're seeing reports that Kraken is finalizing its plans for an IPO in 2026. The valuation they're targeting is north of $20 billion.
That's huge for market integration.
It's a watershed moment.
Hmm.
Right now, Coinbase is really the only pure-play crypto stock. Kraken gives you a second institution-grade benchmark. It just adds another way for traditional investors to get exposure without actually holding the coins.
More optionality, more legitimacy.
Exactly.
And while Kraken is planning to go public, Binance just continues to dominate the derivatives market.
Utterly dominate. CoinGlass reported the global crypto derivatives market hit a record $85.7 trillion in 2025.
Mm-hmm.
Binance captured almost 30% of that.
30%. So what does that dominance mean for the market structure heading into the new year?
It means that despite all the regulatory pressure it faces, Binance is still the overwhelming, unavoidable liquidity engine for the entire market. If you're an institutional trader and you care about execution, you can't avoid them.
Okay, let's bring it all back and summarize the key takeaways for you. First, we had that temporary liquidity tension from options and ETF flows creating a coiled spring. Second, DeFi governance is maturing. It demands real value, like we saw with Uniswap. And third, the Trust Wallet hack really underscores the urgency of client-side security.
Right. The market went through a really profound structural transition under that low holiday volume. The temporary bearish price action, from tax selling and hedging, it's diverging from the bullish long-term fundamentals.
Or it's network stability and regulatory clarity.
Exactly. Network stability, regulatory clarity in places like Hong Kong, corporate integration with the Kraken IPO.
Yeah.
All of that is pointing up. And now that $27 billion options pin is gone. Volatility is coming back. The real key is watching how that institutional capital gets redeployed after all the tax selling is done. We often see a dip in late December that sets up for a January effect rebound. So you should be watching, does the market test 85,000 to find the liquidity it needs to set up that reversal? That's what I'll be looking for. What stands out to you?